Now, Ron Hart is Managing Director of the Hart Group, which is part of Morgan Stanley's wealth management operations, and he joins us now from CNN Centre with more on what and what isn't moving the markets. Ron, welcome to the show.
Thank you.
If you look at what's going on globally, it's quite clear that there is a soft patch in the second quarter, which includes the US as well, by all economic indicators. The question becomes, is this just a blip in the second quarter, and can we expect something better further in the year, or is this the start of a worrying new longer-term slowdown?
Well, there's always worries. Earnings have been good in the United States. Corporate earnings are up 4% year-to-date. Half the companies in the S&P 500 have reported. 70% have reported better earnings than expected. Earnings were expected to be up 1.5%. Again, they were up 4%. So they've been able to do that without revenue increases. The revenue numbers have been flat and not particularly good. They've done it through efficiencies in their company, controlling costs. After 5 lean years of economic downturn, most corporations worldwide have learned to live with less, be more efficient. Technology is taking hold, and we're seeing it in the earnings right now.
But efficiencies and cost-cutting can't go on forever, and it's not really a way to sort of grow a share price longer term. Do you see earnings starting to pick up on increased demand for products, not just in the US, but globally? Comes back to this question. Are we in a soft patch just short-term, or is it a longer-term worry?
Well, that's the big question. We think near-term we're fine. The central banks worldwide have been very accommodative. You mentioned Draghi and the ECB reducing rates today. You have a very accommodative Fed in the United States. That always foretells positive signs for companies because their cost of financing is lower, their cost of funding is cheap. The key is optimism. Morgan Stanley did a investor sentiment poll recently, found that investors are 86% of which are very optimistic going forward. The concerns are the same concerns we've had for a long, long time. Geopolitical concerns, debt concerns, et cetera. But there's always a, climbing the wall of worry.
Absolutely, the wall of worry. As a wealth manager, what are you advising your clients? Because we do see Wall Street continue to climb into record territory, which is obviously not underpinned by fundamentals. This is a QE liquidity story. So what are you telling your people? To stay in the markets and ride this, what could be a bubble, or to stand back and wait and see what happens? Diversify.
There's so many different asset classes now than there were 20, 30 years ago. Alternative investments, people are using gold and commodities a lot more than they ever have in the past. Real estate as well. There's a lot of ways to diversify a portfolio. In the United States, 52% of the retail investors own equities. That's about average long term. It's not low, it's not high. They tend to be late to the party. In other words, the S&P 500 was up 16% last year. It's up 11% year to date. Clearly, it could take a rest. All markets have pauses. They have corrections. This market could be in for one. Maybe it's ahead of itself, but maybe it's foretelling better economic times as well.
All right, Ron, we'll have to leave it there for the moment. Ron Hart, thanks very much for your time.
Good to be here.